Riding the bull, but beware the bubble. A deep dive into 2026 stock picks and drops. The stock market is riding high, with valuations at or near all-time peaks, especially in sectors like artificial intelligence, AI, that have fueled much of the recent bull run. Yet, despite these lofty heights, the broader economic backdrop remains surprisingly robust. Job growth may be cooling, but it's slowing from a sizzling pace, and the economy appears resilient. This dynamic suggests we're not quite in bubble territory. Think early 1999 rather than the frothy peak of 2000. Historically, bull markets often culminate in a melt-up before a sharp correction, and while warning signs are flickering, there's still room to ride the wave. However, not all stocks are created equal in this environment. Let's unpack 3 stocks poised for growth in 2026 and 3 to avoid, drawing on historical context, sector trends, and global implications. Stocks to buy. Speculation meets value 1. Joby Aviation, speculative growth. Joby Aviation, a pioneer in electric vertical takeoff and landing (eVTOL) aircraft, represents the cutting edge of transportation technology. With a market cap of $15 billion, the stock has already tripled on enthusiasm for its upcoming commercial service launch, expected in early 2026 between Abu Dhabi and Dubai. This is a speculative bet. Joby generates no revenue yet and awaits FAA approval for U.S. operations, potentially in 2027 or beyond. However, its potential applications in urban air mobility and partnerships in high-growth regions like the Middle East signal a transformative opportunity. Historically, early movers in disruptive tech, like Tesla in electric vehicles, have seen outsized gains once commercialization kicks in. If Joby doubles again post-launch, as some predict, it could be a win. If not, its tech and talent make it a prime acquisition target for giants like Tesla. Match Group Value Play. In stark contrast to Joby's high-flying speculation, Match Group offers a classic value investment. Owner of dating platforms like Tinder and Hinge, Match boasts a low capital expenditure model and generates over $900 million in free cash flow annually. Trading at just 8.5 times next year's earnings, it's a beaten-down stock, down 14% over the past year, yet it's returning capital aggressively via buybacks, 9% of shares repurchased, and a 2.3% dividend. The challenge lies in stagnant growth, compounded by user dissatisfaction over issues like scammers. A new CEO's turnaround plan offers hope, and with easy year-over-year comparisons, a single strong quarter could ignite a 50% rally. This mirrors value plays of the early 2000s, where out-of-favor tech firms with strong cash flows often rebounded sharply. 3. Global Payments, undervalued growth. Global Payments, a key player in the merchant acquiring space, processes billions of credit card transactions alongside giants like Visa and MasterCard. Despite consistent earnings and cash flow growth over 2 decades, its stock has lagged, dropping over 50% in the last 4 years while trading at a mere 6.4 times next year's earnings, far below its historical 19x multiple. The upcoming acquisition of WorldPay, making it the top player in its space, promises cost synergies and a 50% EBITDA margin. Investor skepticism around debt, $14 billion, and integration risks has suppressed the stock, but these concerns seem overblown given its stable cash flows. This disconnect between fundamentals and price echoes mispricings during the post-2008 recovery, where payment processors eventually soared as digital transactions exploded globally. Stocks to drop, overvaluation and headwinds. 1. Palantir Technologies, extreme overvaluation. Palantir, with a $423 billion market cap, ranks among the world's 20 largest companies, despite generating just $4 billion in revenue. Trading at over 100x revenue and 200x earnings, it's arguably the most overvalued large-cap stock in recent memory. Fueled by AI, defense tech, and political tailwinds, its growth, 48% revenue increase, is real but nowhere near justifying its price. This mirrors Cisco at the 2000 internet bubble peak, when it traded at 180x earnings, only to crash 90% and never fully recover, despite solid business growth. If you've ridden Palantir's rocket, it's time to lock in profits before the inevitable correction. 2. AppLovin, Risky Practices. AppLovin, a mobile app monetization platform, sports a $200 billion market cap and trades at 63x earnings and 36x revenue. While less extreme than Palantir, its valuation remains steep, and allegations of shady practices, tricking users into downloads and aggressive ad bombardment, raise red flags. Multiple activist short sellers have flagged these issues, suggesting a potential sell-off trigger. This recalls the dot-com era's overhyped tech firms, many of which collapsed when questionable tactics came to light. If you've profited, consider exiting before sentiment shifts. 3. Tesla, Structural Challenges. Tesla's $1.5 trillion valuation is staggering, but its core EV business faces severe headwinds. In the U.S., the $7.500 tax credit expiration will likely dent sales post-September 2023's buying surge. Globally, Chinese EV makers like BYD are undercutting Tesla with vehicles priced as low as $8,000, eroding market share outside the U.S. where trade barriers don't apply. While bulls pin hopes on Optimus robots and robotaxis, these ventures are years from material impact. Waymo, for instance, is already ahead in autonomous driving. Tesla's valuation echoes the speculative peaks of past tech giants, where hype outpaced fundamentals, leading to sharp pullbacks. Taking partial profits now could be prudent. Conclusion: investment implications and near-term catalysts. For investors, the 2026 outlook demands a balanced approach. Ride the bull market, but hedge against overvaluation. Joby Aviation suits risk-tolerant portfolios, with commercial launches in Dubai as a near-term catalyst. Match Group and Global Payments offer safer bets for value seekers, with catalysts in quarterly growth surprises and WorldPay integration completion, respectively. On the flip side, trimming exposure to Palantir, AppLovin, and Tesla could protect gains. Watch for earnings misses or negative headlines as triggers for downturns. From a policy perspective, regulators should monitor speculative bubbles in AI and tech, as unchecked enthusiasm could destabilize markets, much like the dot-com crash. Globally, Tesla's challenges highlight the competitive threat from China's EV sector, underscoring the need for Western innovation and trade strategies. Practically, diversify across value and growth, size speculative bets appropriately, e.g., limit Joby to 5 to 10% of portfolio, and use stop-loss orders on high flyers to lock in gains. The market's strength offers opportunity, but history warns us. Euphoria often precedes a fall. Stay vigilant,